Is the market near a bottom? That might be the case. We'll look at the charts today right here on 3 Minutes on Markets and Money. Yesterday we talked about the super negative sentiment and positioning by professional investors really across the board. We haven't seen investors this negative since 2008, which normally suggests that we might be near a market bottom. But is that really the case, and is this the opportunity to start putting money back to work? Well, one of the key differences between now and previous times in history is that we're running the highest inflation level in 40 years. The Fed is tightening their balance sheet and hiking interest rates. So there's certainly some differences to the markets this time than what we've seen previously. And that doesn't necessarily mean that everything works out just as we expect, but the extreme negativity has typically been the case near market bottoms previously. So let's look at the technical charts to see if they're telling us anything different or if they're actually confirming the same. So this is the S&P going back about 5 years. And if we take a look at the MACD indicator, now this is a weekly chart, so it smooths out some of that daily volatility. A couple of things jump out to us right away. The first is that the markets are 2 standard deviations oversold right now from the 50-week moving average. So this is almost a 1-year moving average right here. Markets are deviated well below that. We actually got into 3 standard deviation territory back in May. And the last time we were that low was back in March of 2020. We also saw that temporarily back in early 2016 before we went into Brexit. If we take a look at the MACD indicator, so this is a standard 12, 26, 9 MACD indicator, but it's weekly, so it's 12 weeks, 26 weeks, and 9 weeks for the signal. We see that this MACD indicator is now very low and actually beginning to turn more positive. We've seen this very low indicator right now on the MACD. At the same time, we're also seeing our other oversold indicators very oversold as well and starting to turn up. This suggests that we might see some more follow through with this market here over the course of the next few weeks. So this could be indicating that we're near at least an intermediate market bottom and could have an opportunity for a very decent tradable rally. Now, does this mean we're out of the woods yet as far as a bear market goes? No, not at all. Again, we're having to deal with inflation, slower economic growth, etc. There are things coming down the pike over the next couple of quarters that we are certainly not aware of. But this does suggest that we could be near at least a temporary market bottom. But let's step out and look at this chart longer term, going back to 1994. So looking at this chart going back to 1994, immediately we start to see the 2000 dot-com crash. We see, of course, the great financial crisis of 2008. Here's 2015, 2016 with Brexit, the 2018 kind of sell-off with the Fed taper tantrum, the March 2020 sell-off in the markets due to the pandemic and the economic shutdown, and then, of course, now this very small decline up here is the current bear market that we're in. And one thing you'll notice is that these declines are getting smaller and smaller and smaller in terms of magnitude relative to what we saw in previous bear markets. But here's the interesting point. If we take a look at the MACD indicator as an example going back and some of the other oversold indicators that we have going back, in 2000, during this crisis, we never saw the MACDs and these oversold conditions get extremely oversold, but they did stay oversold for quite some time, but not nearly to the magnitude that we're seeing now. Again, 2008, we saw a fairly deep decline in the MACD indicator, as well as our other oversold indicators got fairly oversold. Those began to reflex rally as we started to come out of this, a bit deeper than we saw in 2000, but not near to the magnitude that we're seeing currently. As we see here, the MACD indicator is currently gotten more overbought than we'd ever seen before in history, and not surprisingly now it's more oversold than we've seen at any other point here since 1994. Again, indicators extremely oversold, beginning to turn positive. So this all suggests that we could be seeing at least an intermediate term bottom in the market. It's too early to go jumping in with both feet here to buy stocks. It's not necessarily time to back up the truck, but there's certainly the possibility here that we could see a fairly decent tradable rally in this market over the next couple of months. That's 3 minutes on Markets and Money. We'll keep you updated right here at realinvestmentadvice.com.